Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to you by qplum, where we'll be discussing a machine learning approach to systematic global macro strategies. So thanks for joining. Now, I would like to introduce Marissa Palestino with qplum, who's going to introduce Ankit, today's speaker. Thanks for joining us, Marissa.
Thank you, Cynthia. Hi, everyone. My name is Marissa Palestino of Client Relations here at qplum. Our speaker today is Ankit Awasthi, a quantitative portfolio manager at qplum. Prior to joining qplum, Ankit was a portfolio manager at a high-frequency trading firm where he led a team of 40 engineers and data scientists trading multiple asset classes across global exchanges. qplum is an AI-driven asset manager using both deep learning and machine learning in its strategy construction. We provide asset management services to RIAs, family offices, and pension funds. We also have an online investing service to directly manage money for individuals and families. We actively manage individual joint accounts, IRAs, trusts, and LLC accounts. Please feel free to submit your questions to us via chat, and we'll address them at the end of Ankit's presentation. I will now hand over the presentation to Ankit to begin discussing a machine learning approach to systematic global macro strategies.
Hello, everyone. So today we'll discuss use of deep learning for global multi-asset portfolio construction. This is a brief outline of the talk. First, we'll briefly discuss what is global tactical asset allocation. Then we discuss why investors need to focus on asset allocation versus security selection. Then we'll see how macroeconomic data can be helpful in tactical changes to asset allocation. And finally, we discuss why deep learning is suitable for this problem, and end the presentation with a case study on where we use deep learning for tactical asset allocation. So I'm guessing most of us know what is a strategic asset allocation. For those who don't, strategic asset allocation is, as the word suggests, strategic in nature and is decided based on long-term capital market assumptions. It incorporates investor preferences as to the risk and reward profile according to those market assumptions. And it largely remains unchanged unless some of these parameters change. In practice, strategic asset allocation is similar to a buy and hold sort of a strategy, with periodic rebalancing to remain close to the specified asset allocation. There are two important assumptions that are made while coming up with a strategic allocation. First assumption is that long-term capital market assumptions of both expected returns and expected risk are accurate. In practice, however, most people simply approximate this using past numbers. So I may say that the expected returns for S&P 500 is the average over the last 5 years. The second assumption is that these capital market assumptions remain consistent over time. What this basically means is that if risk of S&P 500 stocks is 15%, according to my assumptions, it remains at that level over extended periods of time. While in practice, we know that the risk of S&P 500 stocks was very different in 2008 versus what it was last year. And same holds for expected returns as well. Depending on which part of the business cycle we are in, expected returns of different asset classes should ideally be different. Now we discuss global tactical asset allocation. Global tactical asset allocation is based on both long-term and short-term capital market assumptions. It incorporates investor preferences as to the desired risk and return profile based on these assumptions. And given that these assumptions are changing over time, the underlying asset allocation also changes over time. Moreover, in practice, if the long-term capital market assumptions are consistent with the strategic asset allocation, on an average, tactical asset allocation is similar to strategic asset allocation over a long period of time. Now it's time for our first poll question. Okay, so here are the responses. So the question again was, which of the following is least likely to be a tactical decision? And most people are saying that moving all equity allocation to FANG stocks would have been a tactical decision. So, and second best is move all fixed income to long-term bonds and emerging market equities and reducing allocation. So typically tactical asset allocation doesn't refer to security selection. But I guess most of the people got it right. So let's now focus on why asset allocation is an important problem to solve. There are many reasons for focusing on asset allocation. First and foremost, asset allocation is the biggest driver of return versus security selection. For instance, when a recession hits the market, there's only so much one can gain by allocating in one stock versus another, because the entire stock market is likely to suffer to a great extent. But it is likely that by allocating to fixed income, losses can be avoided. Moreover, some of the biggest allocators, such as pension funds, historically have just logged in a certain asset allocation and focus on security selection within each asset class. And that leaves a lot of opportunity on the table for people who are dynamically changing their asset allocation. As we have often mentioned in earlier webinars, macroeconomic data is one of the cleanest source of data available with high coverage and long history. Macroeconomic indicators have a bearing on financial markets, and we'll discuss two specific examples here to explain the same, namely unemployment rate and yield curve inversion. So in this plot, unemployment rate is plotted over time since 1954, and the gray regions signify the periods of recession. As you might have noticed, troughs in the unemployment rate are followed by recession, or in other words, bottoming of unemployment rate could be a good predictor of upcoming recession. One of the problems with predicting recession in a data-driven fashion is that there are so few instances that it is very easy to overfit. Therefore, it is a good idea to not just focus on one indicator, but look at a range of different macroeconomic indicators and combining them. Moreover, it is important to realize that the relationship between these economic indicators and successful prediction of expected returns is fairly nonlinear in nature. For instance, there's no easy way to come up with an analytical expression for troughs in unemployment rate series. So the next economic data that we look at is the yield curve as a potential indicator of recession. In this graph, the difference of 10-year yields and 3-month yields is shown over time, and the gray bars again show periods of recession. Again, it is not very difficult to observe that yield curve inversion is a good indicator of upcoming recession. For the interested audience, there was a very good paper by Federal Reserve Bank of St. Louis that discusses these two macroeconomic numbers in more detail. So just to summarize the discussion till now, we have discussed how tactical asset allocation is an improvement over strategic allocation, and how macroeconomic data can help us update our capital market assumptions, which eventually help us do better asset allocation. Next, we'll discuss why and how deep neural networks are suitable to achieve this. And now it's time for a second poll question.
Which of the following macro data would be least useful for business cycle change detection?
Okay, so we have the results here, and very rightly so. Most people guess that US crude oil stocks would be least likely to predict a change in business cycle. So moving on, let's now discuss why deep learning could be a useful tool to aid in tactical asset allocation. As we discussed earlier, the relationship between the macroeconomic indicators and corresponding changes in expected returns of different asset classes are typically non-linear in nature. Moreover, using only a few macroeconomic indicators exposes us to the risk of overfitting just based on one number. Therefore, we need to combine multiple features together to update expected returns of different asset classes. And these are exactly two key advantages of using deep neural networks. I think we all agree that signal to noise ratio in financial time series is much lower than most other applications. And as a result, point estimates for expected returns can have significant errors and are therefore inadequate. They need to be supplemented with some measure of confidence along with the point estimate. In the following case study, we use dropout as a means to derive these uncertainty estimates. Dropout is a regularization technique that is commonly used in deep neural networks. We'll discuss later how we use dropout in our particular context. Now it's time for the third poll question.
In which of the following applications using model uncertainty is least important? Okay, we'll be closing the poll shortly. Please get your votes in.
Okay, it's good to know that I think most of the audience feels that a hot or not app would be less important than diagnosing cancer from scans. Again, moving on. Um, Now we'll discuss a case study where we used a feed-forward neural network to come up with a scheme for dynamic asset allocation. As I mentioned earlier, using just one macroeconomic data exposes us to the risk of overfitting based on just that series. Also, given that the functional from the macroeconomic data to expected returns is highly nonlinear in nature, and using any parameterized form of mapping from these indicators to expected returns is going to suffer from some amount of overfitting. Therefore, we spread out the risk across different macroeconomic data points. Obviously, some of these are more predictive of recession than others. These are the list of securities that we used for this case study. So we mostly use ETFs, and these ETFs signify different asset classes. If you see, they cover most of the broad asset classes, and the choice has been one, to make sure that the expense ratio of these ETFs is low, so that the final results are closer to just using those indices as a proxy. The other is they cover most of the important asset classes. And the last point is that we try and make sure that the AUM under management for these ETFs is high. Let's discuss the expected returns model that we used for this application. So the input layer has macroeconomic features and price action features. So the macroeconomic features are simply the macroeconomic indicators that we listed earlier. For the price action features, we use lag returns for the securities that are listed. So for different asset classes, for each asset class, we use 4 different look-back durations, and we use lagged returns for that look-back period. And then we have 3 hidden layers, which then map to the expected returns of each security. The hidden layers have a dropout with a probability of 0.5. So what is dropout? Dropout is, as I earlier said, is a regularization technique that is very commonly used in deep neural networks. In dropout regularization, we drop out certain connections in the network randomly with a specified probability at the time of training, so as to distribute the responsibility of making correct predictions across these connections. For those who are familiar with ridge regression, this is similar to how ridge regression distributes the weights across features rather than having concentrated weights. In our case, because we are interested in getting uncertainty estimates along with the expected returns, we retain dropout at the time of inference as well. So what we do is we retain dropout with the probability of 0.5 at the time of inference, and we run around 1,000 Monte Carlo simulations to get different estimates of these expected returns. And finally, we use the mean of those different estimates as our expected return, and the variance in those estimates as the uncertainty. This figure shows the walk-forward training and testing paradigm that we used for this expected returns model. So we use an initial set of around 500 days for coming up with the first model. Then every 30 days, we take in the new data and tweak the model a little bit to adapt to the new incoming data. Now, it is very important to make sure that we're not learning the network altogether again, because then the weights will be very different from what you had learned in your first iteration. In order to address this point, what we did was, for the first time the model is learned, it learns up to 100 epochs. And in later iterations, it only trains for 5 to 10 epochs. Walk-forward optimization helps us in better out-of-sample performance. The other way it helps is it's not betting on the parameters themselves. What it is betting on is this policy of learning weights. The way I'm coming up with the weights for models as I'm going on in time is important. And most of the experiments that are done on a predefined training, development, validation, and test data sets almost ignore the fact that at some point in future, you'd have to retrain your model to capture the information in the incoming data. So this is the scaled performance of the expected returns model. As you can see, and here what we've done is we've plotted the mean exponentially weighted mean of absolute error across all asset classes, and we've scaled it to 0 to 1, just to show that where it goes wrong. So if you see, part of it is driven by the volatility of the markets themselves, but it's interesting to see that the error does spike up around the times of financial crisis. Inspired by this, we later on added error correcting feedback in the final position sizing as well. But let's first discuss how the model uncertainty that we were computing using the variance in our Monte Carlo simulation compares to the volatility. Now, if you think about it, volatility serves as a very natural measure of uncertainty in my estimates. For instance, if I'm predicting something that is more volatile, my error in that security is likely to be much higher than something that is less volatile. In that sense, volatility serves as a very intuitive measure of uncertainty. So here what we're doing is we take the model uncertainty as derived from the dropout variance as one measure, and lagged realized volatility as another measure. And it is interesting to see that for a number of securities, the correlation between these two measures is not very significant. The other pattern that emerges here is that for securities with higher volatility, the correlation is higher. So for fixed income, you see much lower numbers as compared to equities or real estate securities. This figure shows the final portfolio construction logic that we eventually used. So we had the expected returns model that we had computed earlier, and we patched that in here. The other two things that we add to our final position sizing logic is the model uncertainty that we compute from the expected returns model, plus an error correcting module which is computing the errors in our estimates in, let's say, last 1 year of data. By the way, I think one important detail that I missed earlier is the expected returns are supposed to be calculated on with a horizon of half a year, 6 months. Now, all these modules, the error correction, model uncertainty, and the expected returns from the expected return model, feed into one small hidden layer of around 4 to 5 hidden units. And finally, on top of that, you add a softmax layer to get the asset allocation itself. So the final layer is not trying to predict the expected return or how the model does. It directly outputs the asset allocation. And this is why we are saying that this is a utility function-based position sizing logic. The basic idea here is to learn the allocations directly based on a performance metric, like Sharpe ratio, like alpha over a benchmark, things of that nature. The utility function here that we ended up using, we used a very simple metric. We used just the Sharpe ratio of the allocations that were output by this network. And in order to make sure that these allocations are not very concentrated, we added some regularization which favored sort of distribution of weights across different asset classes rather than very concentrated allocations. Now, the real advantage of using something like this is that this is a very flexible way of expressing your investor preferences in portfolio construction. For instance, in this case, instead of Sharpe ratio, I could change my metric to Sharpe ratio plus some diversity plus a hard constraint that makes sure that my allocations are differ from a strategic allocation only by a certain percentage. So I can put hard limits on my active share, on turnover, and on a bunch of metrics. And all of this dictates my daily allocations. And because all of these are fairly easy to express analytically, they make for fairly decent objective functions for the training purpose. So let's go over a poll question now. And
the question is, risk parity is not a blank. Everybody please get your votes in. This is our final poll question.
okay, so we have the results. So most people think that risk parity is not a constant risk allocation. Well, in some ways it is. The correct answer, in my opinion, is it's not a strategic allocation in the technical sense of the term. It is certainly a tactical asset allocation because based on the risk estimate, it is tactically changing the allocation. So let's move on to the results for that we got for this case study. So on the top, we are plotting the results since 2000. And for comparison, we use risk parity. And here so we compare performance across different versions of the strategy that we use. In one version, for the uncertainty estimate, we use just the volatility estimate. And in another version, we use the uncertainty measure that we derived from dropout variance. As you can see, the model that uses realized volatility, although it has better Sharp, the return numbers are much lower compared to the risk parity strategy. But all in all, the point I'm trying to make here is risk parity is a heavily researched strategy that has very deliberate parameters set in. And this strategy that is totally learned out of data is able to give comparable performance to risk parity. This is the asset allocation that we get for this version of the strategy. So here we did not have any explicit constraints on how the asset allocation can change over time. And therefore you can see that the model takes decent amount of liberty in the sense that the asset allocation can change drastically over time. These are the results for when we use model uncertainty based on dropout estimates. Now in this case, you can see that the risk parity significantly underperforms the models. Although if you look at in terms of the Sharpe ratio, the numbers do look favorable for risk parity. The result for different runs here basically just means that we use the different seed at the start. So when you're training a neural network, we have to initialize the weights with some random weights. And that leads to apparently significant changes in the results. And one good way to counter this in practice is to sort of average these over multiple models. This is the asset allocation for the model that uses model uncertainty. Again here, because we did not use any explicit constraint or a hard constraint on turnover or asset allocation, we see that it can change quite drastically over time. Now, the earlier results were on a period where some hyperparameters, like the number of days we used to update the models, these were some hyperparameters that were learned in that data. And since 2014 onwards, we did not use any of the data for learning any hyperparameter. And it's good to see that the performance still holds up, although risk parity does catch up in this part of since 2014. And one reason could easily be that there has not been the macroeconomic data which suggests a business cycle changes have not been active in this period at all. So if you look at unemployment rate, although right now it is almost bottoming. Similarly, yield curve inversion, it is getting closer to where it sounds dangerous, but not quite there. And the other model that we are comparing here is a model where we simply use the expected return by volatility for allocation. And that for natural reasons, it's not doing as well, because it is trying to optimize expected returns rather than the allocations themselves. So there's a higher likelihood of overfitting in the expected returns strategy. So what are the future improvements that can be done in this particular strategy? We could increase the coverage of our macroeconomic variables to further distribute the risk of overfitting. The other thing is we could come up with better estimates of model uncertainty. Right now, we just used dropout variance as one estimate. Use of hypothetical data to learn price volume features. Now, it is very hard for us to generate artificial or synthetic macro data. But for the price volume features, we have evidence that using high frequency data could be very useful to learn meaningful price volume features that can be used in outer sample data. The other clear improvement could be to explore other neural network architectures for doing this. Asset allocation. Finally, what are the key takeaways from this presentation? So these are the few points that I want people to take away from this. Is we discussed the systematic way to do walk-forward training and optimization of deep neural networks for financial time series data. Generally, for deep neural networks, availability of large quantities of data is paramount. But specifically in finance, it is all too easy to overfit if you work with a training, validation, and a test set kind of a paradigm, where you have to in practice constantly adapt to changing market conditions. Therefore, searching over a policy of learning weights rather than learning the weights themselves is a very good practice. The other thing we explored in this presentation is Bayesian deep learning. What that means is that instead of just looking at point estimates, we always want to get some sort of a confidence score, some sort of uncertainty estimate. What does it mean when I say that I expect S&P 500 to return 5% next year? That is a very loaded statement in the sense that 5% is a point estimate. And unless it is accompanied by a confidence score or a range, it is as good as meaningless. The third thing, and I think one of the most important parts of this presentation, was to use a utility function rather than the canonical measures like mean squared error as the objective function for training a deep neural network to directly determine what we want. Often what happens is that you learn a model to predict something that is analytically easier to solve, but that doesn't directly solve the business utility that you're trying to target. And in this case, we are able to express investor preferences like Sharpe ratio, closeness to benchmark, or strategic allocation explicitly in a quantitative fashion and then use it to train the neural network. And last but not the least, deep neural networks offer a very flexible and powerful framework to do tactical asset allocation. Now we open this up for questions.
And at this point, everyone, I would like to remind you that there is a questions panel located in the control panel on the right-hand side of your screen. Simply double-click that title bar, or you can click and drag it and expand that section and send any questions you might have for Ankit at this time. Back to you, Ankit.
We'll now address a question from Diego. Isn't it extremely sensitive to the starting point?
It is fairly sensitive to the starting point. As you could see that the result of various runs had quite a bit of variance. So one way to fix it is to just fix the seed, but that is just artificially fixing the problem and giving one number as the output. How to genuinely fix the problem is to reduce the number of parameters in your model so that the variance reduces. And the other is to use average across multiple estimates to get the final number.
Did you try this model without the entropy constraint? If yes, what was the asset allocation results?
We did try, and we got very concentrated portfolios, which is kind of expected.
There's a question from Alessandra. Did you account in backtesting for the fact that economic indicators are lagged 1 month or more and revised over the following 2 to 3 months? Please explain that.
So all the data that we used, the economic data, we were very careful of using data that is free of revisions. So all of the data points that we used were point-in-time estimates. I think the performance in the outer sample data is mostly because all the macroeconomic features that are highly predictive, they're predictive within a very narrow range. For instance, unemployment rate is useful to update the expected returns only when it is bottoming out and not otherwise. Similarly, the yield curve is predictive when it is close to inversion, and at other times it is not really a good predictor. In fact, we actually studied just the correlation of difference of yields, and it was of a different sign. So that also suggests that the relationship between these variables and the expected returns is very highly nonlinear in nature.
Any particular reason why 0.5 probability was chosen for dropout filter?
Not really. This was one number that is very commonly used in practice, and we just did not experiment with this.
We have a question from David. What deep learning library are you using for this work?
So for most of our work, we use TensorFlow. So yeah, we use TensorFlow for this application as well.
The next question is from Robert. Any T costs or fees included? Seems to be a lot of turnover with monthly rebalancing. Any edge might exist after T costs and fees?
So in the interest of brevity, we did not include the estimates for slippage cost and trading cost assumptions, but we took very strict or rather conservative slippage assumptions when executing the trades, being mindful of the high turnover of these strategies. So yes, we did take all of these into account.
The next question is from Paul. In the context of GTAA, have you thought of using reinforcement learning to learn the policy of allocation?
We have not yet explored reinforcement learning, but for one, I'm very excited about reinforcement learning. So that's why one of the future works is to explore different architectures of for doing tactical asset allocation and exploring other paradigms of machine learning like reinforcement learning for this purpose.
The next question is from Lionel. How long did it take to develop the deep learning model, and how long does it take to provide the results?
So in our case, the number of training points were not really very high in number. The fact that we are doing walk forward training and testing, it does increase the time of the simulation significantly. But I would say that even if you run on a CPU, it runs in around 20 minutes.
Has tactical asset allocation outperformed a classic 60-40 portfolio historically?
So tactical asset allocation is a very broad range of asset allocation schemes. I could be tactical in a very different way. You want to be tactical. So there's no one 60-40 obviously is an absolute portfolio. But in most cases, for instance, what we have observed is that simple risk targeting, as in to say that on an average, I will target the same risk as 60-40, but I will do that in an online fashion. And we have seen that simply just doing that outperforms the 60-40 allocation.
How does the model take into account liquidity and speed of moving between asset classes?
This is a very good question. Typically, large allocators such as pension funds are worried about this a lot. Therefore, we developed the framework in a way that you could put in explicit constraints for turnover and deviations from a strategic portfolio. As far as liquidity is concerned, I think these are asset classes which are very, very liquid, especially the securities that we chose can easily deploy billions of dollars. So I don't think liquidity is a big concern here, but I agree that turnover could be a point of concern for a number of allocators. Therefore, it could be used as a hard constraint at the time of portfolio construction.
The next question is from Matt. How many data points did you use in your training set? Don't deep neural networks need millions of data points to train?
So that's a very valid concern, and that is why we chose a much smaller network for one. And the other thing is, even though the network is small, on top of that, we use the regularization like dropout with a fairly high dropout probability like 0.5 to ensure that we are not overfitting. The other way how we address this is walk forward training and testing. Is instead of learning one set of weights, we are saying that what we want to test is the ability of this weight learning policy to do well over time. So for us, when we are running this portfolio in live, we don't have to change anything. It is part of the policy that every 30 days, the model gets updated with the new data as it comes in and changes its weights accordingly.
Strategic allocation is supposed to be long-term. How frequently should one revisit the asset allocation for tactical purposes?
It depends on investor preferences. Like, let's say if I want to target a certain risk profile very closely, I would need a higher tactical changes to the portfolio to make sure that I am close to that risk number. Similarly, turnover constraint could be another reason for another parameter that would decide how tactical you want to be.
The next question is from Ian. Did you try any simpler benchmark learning algorithms, for example, linear regression, before moving to using deep learning models?
So like I said, we did use linear models and they bombed completely. And part of the reason is that these indicators, the way they have a bearing on the expected returns of different asset classes is highly nonlinear in nature. For instance, like I mentioned, that unemployment rate in general might not be very suggestive of drops in S&P 500, but especially when it is bottoming out or when the non-farm payroll numbers are negative, then it is very indicative of underperformance in S&P 500 stocks.
We have a question from Robert. Can a minimum variance portfolio be used as a benchmark for the strategy? And if so, what would it look like?
So although we did not show the results for other portfolios, we did have, because we thought risk parity serves as a very natural benchmark, as in it's a heavily researched tactical asset allocation strategy as opposed to a strategic allocation. So we did compute minimum variance and a constant max Sharp portfolio. And the results, although the max Sharp portfolio with absolute knowledge of history does better, but in terms of the net returns, it fares much worse than some of the models presented here.
Paul asked, how long is the optimization period and how long is an epoch?
I'm sorry, I didn't realize that I was on mute. So let's repeat the question again. The question was, how long is the optimization, what period is the optimization done on? Is it 1 year? And what is an epoch and how long is that? So the first model is trained on a period of 500 days, roughly 2 years. And then every 30 days, we update the model as the new data comes in. The first time the model is learned, it is learned on 100 epochs. What is one epoch? One epoch is going through the training examples once to do gradient descent at the time of training.
So I think we've addressed all of the questions that we received. We have a couple of questions coming in now. Why is risk parity used as a comparison here?
Like I said, risk parity is a heavily researched tactical asset allocation strategy, and it served as a fairly good comparison.
And one final question. Why can't we simply handcraft these features if nonlinearity is needed and overfitting is a concern?
So one of the things that I do not want to do is actually handcraft the features as to maybe detect troughs in the unemployment rate. And the reason is that that is also marred with overfitting. Although on a perception level, like I've seen the data and now I'm trying to model this functional form. The other thing is it's not scalable. Right now I'm using, let's say, just 15 data points. Just the unemployment report has around 200 data points that I might want to scale to. And at that point, handcrafting features is no longer a viable way of doing this.
Okay, that concludes the question and answer portion of our webinar. For any attendees who are RIAs, foundations, or pension funds, please know that QPlum offers actively managed portfolios at a flat fee. Please feel free to send any additional questions to contact@qplum.co. Thank you everyone for joining. We look forward to having you join our next webinar where Anshul, a quantitative portfolio manager at QPlum, will be discussing modeling of risk in quantitative portfolios, and that'll be on November 29th. We look forward to you joining.
Well, thank you so much, Ankit and Marissa. Thanks for today's presentation. Now, I do want to remind everyone that we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as a PDF copy of the notes that we've been using today in your inbox. We'll be sending that out shortly. So if you do want to come back and revisit the concepts that Ankit was talking about, simply watch your inbox later on this afternoon for a direct link. By the way, today's event will also be posted on the Interactive Broker website. Underneath the education menu, there's a webinar section that includes a section on our recorded archives where you can find not only today's event, but any of the previous events by simply filtering for the organization QPlum. So with that, we are going to end today's session. I also want to thank all of you for your participation with us here this afternoon. You can exit using the X in the upper right-hand corner of the screen. Thanks all. Have a great rest of your day, and do remember to check your inbox later on. Thanks, everyone. Have a good one.